get to the end, there's some planning concepts I'll touch on that kind of address the equalization and how to have that conversation. Yes, you make a good point. What was relevant as a viable gift 15 years ago, you know, if in the example I shared, that if someone gave a gift of $100,000 10 years ago, and then like we're going to take that out of the $100,000 when I settle my estate 10 years from now, I mean, 100,000, you're still going to get your share, just minus 100,000 being pre-gifted you, regardless of time value of money. But if it's a share, if it's leaving the cottage to one family member and it's leaving something else to a different family member, but the values have disproportionately changed, that comes back to the fair isn't always equal.
Yeah.
Right? So how do you plan for that? And I'll talk about that in the next slide.
It's also not even just the value, like the taxation.
Well, that's another part of the consideration, right?
Yes, yes. Which one triggers capital gains, which one doesn't? I actually just helped an elderly couple with their estate plans. And they didn't think they had a lot because they bought their real estate when they were younger, many years ago, 25 years ago, right? So they had a primary residence and they had a secondary residence, okay? And they were shocked when I told them about the capital gains that their death was going to bring about. And they're like, oh, I shouldn't have bought a second house. I'm like, no, that's not the answer. We just need to understand. And they had this whole plan of leaving one house to their grandkids. You know, one of their children has 2 kids, the other one doesn't have any. So they plan to leave one house, bypass that son, given, like everybody was good and everybody was in the meeting and understood everything, so it was okay. But they wanted to give it directly to the grandchildren. I said, you can't do that, they're minors, first of all. And this is the problem. And then they were gonna give the other property to the daughter, which would actually be her primary residence. I said, well, you need to understand that this house that you're giving to your son or his kids is not going to be equal, even if they are at fair market value equal right now, because he has capital gains. Like if he's getting the estate and he's the trustee, he has to pay all your capital gains and your final tax returns, etc. So this is actually how much he's going to have left. Okay? So then we got into, you know, what other investments, registered or non-registered. If you have registered investments, maybe he can be the beneficiary only of some of those to offset some of that and give him some cash to, you know. It's just knowing what you're dealing with, having the proper conversations, and you can make a plan that accounts for a lot of these things.
It's funny
right?
you said that.
Hmm?
It's funny you said that.
Yeah?
Yeah, because we'll talk about that in a second.
Okay, there you go. Okay, so next topic is digital assets.
Who
I'm
has
gonna-
email?
Yeah.
Who has a social media profile of some sort somewhere? Okay.
Okay, who has a computer
Yes.
and an iPhone or whatever other smartphone? Okay, so here, a lot of people don't think about those things as assets, but they actually are your assets, right? If something were to happen to you, are all your favorite pictures that you've accumulated over the last 15 years gone? Who's going to be able to unlock that phone and get to those things? That would actually want them, right? Sometimes it you know, your social media accounts. When you pass away, do you want them to just sit there forever? So I've seen Facebook, I've seen Apple, and I've seen LinkedIn. I've seen all of them giving people such a hard time to, one, access the accounts, but forget even that, shut down the accounts after somebody passes away, okay? It's very difficult. So what you want to do is you want to have a plan in place. Put somewhere, you know, where all these passwords are at the very least, right? Cryptocurrency is its own beast. And I'm sure you've heard some of it about it, like it was a, you know, hype topic for a while and whatever. Some people have it now, some people don't, okay? So yes, you need to plan for your cryptocurrency or else it can be lost completely, all right? But for all these other assets that you don't think about, make sure there's a plan. Like if you do, and I say computer because who can log into your computer? Who knows your computer password to get in there? And that maybe where all you're so organized and you have all your tax returns saved in there and you have everything, but nobody can access it. So what have you done?
Who's
right?
going to cancel the cell phone?
Who is going to cancel the cell phone?
You ever tried to change your cell phone? I don't know who's going to cancel it. If you're not the only person on the account, let alone you're deceased. Like, and only having worked with a number of states, if you've ever settled in a state and you start to make these phone calls, it can be an arduous task.
Yeah. Okay, so this is you. Are you have it in here?
Sure.
Yes.
All right, so a lot of the decisions that people make when it comes to their estate plan, and you talked a little bit about it with joint ownership at the beginning. We do things sometimes to avoid what we think is a real big problem. And That's the probate and estate administration fees associated, probate fees. I wanna hide money, I wanna make sure my siblings or my daughter or my son or whoever's a joint account holder, because I don't wanna pay probate fees. The biggest enemy of estate planning is what we call the big tax. That's income tax. This is the little tax. This is really not that much. Like on average, what is an estate tax?
Oh, it depends, because now we have real estate that's very valuable, right? So, but, I mean, it doesn't compare to the
It's
income tax. Does
basis
anybody know
points.
what the estate administration
Bill, you know the
tax is,
estate
probate
administration,
taxes?
don't you?
Yeah, half percent on the first 50,000, 1.5 on the balance over 50 in Ontario. You live in Alberta, it's next to nothing, so if you don't wanna pay probate, you can move to Alberta.
Just before you die.
It does vary from province to province, okay, in Ontario it is 1.5% on your estate, anything over 50,000. So if you have an estate less than 50,000, you pay nothing on it, okay?
In Ontario?
It used to, yes, in Ontario.
It used to be 0.5%,
It used to be-
150,000, right?
Yes, it used to be 0.5% or five, yeah.
Now it's
it was
0.
500 basically for the first 50,000, which is what you're thinking of, and then after that it's 1.5%. Now it's just nothing for the first 50,000, because frankly, if you have 50,000 in our day and age, it means nothing, like it's not a lot. And then anything, the net value of your estate, so if you have property with mortgages and stuff, you subtract that, right, to get your net value, 1.5% on that.
And when you think about it, there's a lot of dancing that goes on to try to avoid paying like maybe a couple $1,000s in administration fees.
Yep.
And sometimes it creates major problems in the distribution, equalization, and larger income tax. You can go to the next
Yep.
one. So when we think about what creates taxes at death, essentially when you pass, it's as if you had a yard sale and have sold everything you own the moment before you passed. So that includes pension assets, RRSPs, tax-free savings accounts, investment accounts, real estate. All of that stuff is as if you just put a massive for sale sign up and it's got to go. Now, who's getting it? Where are the proceeds going? How does it roll over? Deemed disposition is done at the fair market value. And that's a whole capital gains conversation has even become a little more complicated right now with the most recent budget announcement of the capital gains rate moving up for individuals to 2/3 effective June 25th from 50% inclusion rate. At least that amounts over $250,000 for individuals. For corporations, it's on $1. So that's a whole other presentation, I think, to get into tax planning, but for the purposes of today, when we sell everything, what is the tax bill? And I would challenge anybody in this room to be able to accurately say, I know what my tax liability would be tomorrow if I passed away. Now, we can help with that. I mean, it's a good news, bad news thing, right? Because you're kind of gone and you have to pay the government, but at least if you know what you're dealing with, now you can do some planning to say, okay, how much do I want to mitigate that, right? So the deregistration of assets creates a taxable event. So if you have a RIF, you have an RRSP, that is like you received a massive paycheck from an employer or from the government, fully taxable, unless you have a spouse, in which case there is a rollover provision. You can move the money tax-free over to a spouse. But now we're getting into the nuances of beneficiary designation. And one of the things that we've come to see in some planning situations is the timing of when you name the beneficiary. Now you would have seen this, and I know Bill and I have seen this many times, is whatever is most recent, right? If I have an RRSP and I name my spouse the beneficiary, and then I go see Marlene and I do my will, but I say in my will the beneficiary of my RRSPs is something different. My understanding is the law looks at whatever's most recent. Now, if you're changing financial institutions sometime, or you're having planning discussions, or you're dealing with pension assets, it's really important to make sure that your estate plan is aligned with what your intentions are with your money. Now, in most cases, if it's in your common law or spousal relationship, you're going to take advantage of the spousal rollover provision. But that's not always the case. In some cases, you might say, well, I just decided to add my friend, my brother, my cousin, my caregiver as the beneficiary, a part of my RRSP, but that's not what your will says. But you changed the beneficiary designation on a registered plan. This is why it's so important to be working with your financial advisor, because your financial advisor should have some of these things and make sure that you touch base with your lawyer to get back on track with your plan, so you don't mess things up.
Because the bottom line is, even if it trumps, your current plan trumps, you're still gonna get into a dispute with that person that was named on the other beneficiary, and who's gonna end up resolving it? The court, if it can't be resolved within, right? So you're still getting caught up in that same situation where you're stuck going to the court and getting them to interfere and get involved. And whenever that's the case, it's gonna take time, it's gonna take money, and it's gonna cause a lot of stress, right? So even if you've done well enough to get your estate plan in place, we want it to be consistent across the board, okay?
So I just talked about this. Obviously, you're looking at the principal residence exemption. It's, you know, you're not paying capital gains tax on it specifically, and there's opportunities with charitable giving too. So when you start getting into a deeper aspect of financial planning and your estate plan, sometimes there's benefits to donating assets in kind as through your estate, or you know, if you're doing some advanced planning. And we're seeing this actually in people who are approaching end of life too, where there's some active conversations going on about charitable giving and making donations in philanthropy. So all of these things should be taken into consideration in your estate plan. And not everybody's looking at the same solutions, but there's many ways to mitigate the erosion of your estate through proper planning. We did talk about this, so I think we can go past this one here. This one here, the direct beneficiary designations, I mean, you could talk about that. Yeah. I think really it's about, you know, being clear about who you're naming, and like naming grandchildren as the beneficiaries of a RIF can create some problems, especially if they're under 18. The rollover provision applies if you're dealing with your spouse. You know, tax-free savings accounts, great. You get the opportunity to have your spouse become the beneficiary or the successor holder. The difference is if you leave your TFSA to a non-spouse, it's not treated the same way as if you leave it to a spouse. Right? They get the money tax-free,
Yes.
but they don't get the same benefits after the fact of taking the money out.
So there's language that has to be used to actually transfer it into their account rather than them being the beneficiary of your TFSA. So there's a little bit of special planning there. But also with the RSPs, I think a lot of people don't realize that when you, let's say you have RSPs and you're trying to plan to make it a little equal for your kids, and you know, you helped one kid out buy their first house, and instead of doing that with the second kid, you're just gonna make them the only beneficiary of your RSPs after your spouse who's already passed away. Something like that, right? $200,000 in your RSP, and I gave the same to my first child, so it should be equal. Okay, well, what actually happens? Well, yes, you're right. That second child does get that RSP in hand, right? They're gonna get the $200,000. But, as David said, it's a tax triggering event. So, it's still considered sold, those $200,000. Your RSP was still considered sold. 66.7% of that, or however, we're gonna go with the 50% right now, just for ease of math, okay? 50% of that value is going to be added into the final tax return for the person that's passed away, the parent that's passed away. That's $100,000, right? That's already putting them in the highest tax bracket, whatever their taxes might have been before that. So now, that $100,000 is being shrunk, right? So there's another tax bill of $50,000. So if, let's say, you know, that second child, the son, was given something in the will to balance that out, or he was given something previously. Well, now you've just taken out at least $50,000 of what you thought you were giving them. So it still results in unequal distribution. Guess what's going to happen? They're going to fight, right? So you just gotta be
We see that a
careful
lot,
with the, yeah,
actually.
with the direct. That's what we're speaking about here when you're naming people as direct beneficiaries on some of these things. You need to be aware of how it's actually treated at your death. Okay.
Go to the next one.
Mm-hmm.
This is for you.
Yes. Who here has been tempted to use a will kit? Oh. Okay, please don't. I know there's a lot of hype about a lot of products that are coming out with that offer you, you know, estate planning online. You pay $30 or $100 or whatever it is, and you get this whole plan. Fantastic. Guess how many people it works for? It's actually a suitable plan for. Yeah, I would say 0.25% of the public. That's my opinion personally. Okay, but oh, sorry.
You're good.
The reason they don't work is just stating the obvious. You're not having a conversation with anybody, right? They're not asking you, what are your relationships like with your family members? You know, does everybody get along? Okay, you want to name this trustee. Is anybody gonna fight or be insulted, or can they actually manage the problem, the responsibility, right? A will kit is not going to walk you through the details of who can be a witness necessarily. Like I think I've seen a lot of them. These are some of the issues that I've seen arise from people that have done wills with will kits. They choose the wrong witnesses that are not allowed under the law. So now you're going to the court to get them. And I actually had to deal with an estate that had that not too long ago, where what was it? I think the daughter was the trustee and the beneficiary, and her husband was one of the witnesses. That's a no-no. Okay, so they didn't know. They used a will kit and said, "Who do you want as your executor?" Okay, sign 2 people. Okay, fantastic, right? So a lot of the ways that these wills get set up, just in the details, are often incorrect. Which again, like they're just such a trap for litigation. They do no tax planning, obviously. It's a will kit. So they're not going to talk to you about your assets and how you want them. People that use them think, okay, I know who I want to leave everything to everybody, or I want to leave everything to, to all my children, or what, they don't know what's actually involved in that, okay? So, you think that they're going to save you money. What they're actually going to do is deplete your estate later on. You're either going to pay a lawyer, a professional, or professionals now to get the proper plan in place, or it's going to be paid after you pass away, probably tenfold, right? Lawyers win, frankly. Litigation lawyers win when people have poor plans. That's the reality. Yes.
I know somebody who just did one of those.
Oh.
They don't have property.
Mm.
They have one child. So that when they do pass, it's been designated that their child will get, and it's an adult child. So the adult child will get, they'll basically only have, because they don't have investments either, so basically it's just the cash that they will have, because they rent, they don't have.
And that's the
property.
0.25%. That's fantastic. That is not the typical person's situation.
Right.
Definitely not in this room.
Yeah,
Right?
okay.
So I'm not saying it can never be used. I'm just saying that take great caution. And if you're even entertaining the concept or the thought of using it, you might at least want to get some advice and see if it does make sense for you. Like in that very simple situation,
It's
where it
okay.
is one adult child, one spouse, they're not even, like there's the last person to pass away, one adult child, they own nothing, really, or very basic stuff, then yeah, sure, maybe. But beyond that, and still, that's with the caveat that they've executed it properly, that they've put everything in place, that they have the proper affidavits to go with it. If all of that is in place, which they can't do themselves, the affidavit, frankly, so that's still gonna be something that's often missing when they do the will kits, right? You still have to have an affidavit of execution.
And even in that
So-
situation, if it's only gonna be whatever cash that deceased has, they wanna give to their adult child, how is the adult child going to get that money,
Right.
right?
Yeah, well,
If it's,
they've got 2 other designated beneficiaries other than that adult child.
yeah.
As alternatives? You mean, or as
I'm
well
sorry?
as? As
In addition to.
alternatives, or in addition to
No,
that?
in addition to.
Oh, why?
So they've got the, no, they've got the adult child that they're gonna give the bulk of their monies to, and then a portion of the remaining monies to
Okay,
other.
but often the language that's used in those things is not clear, or leaves ambiguity, and then, again, the trustees have to go to the court to get direction and instruction. If it's not clear how to deal with it, they're going to have to get the court's instruction of how it should be dealt with, or should this gift even, should it make it through, or does it lapse, right? So, again, not saying they're all bad in every single situation, but in more than not, it's gonna lead to a lot more expenses and a lot more complexity and a lot more disputes. That's my experience, and I expect to see more of them currently. Yes.
You talked a lot about different types of assets, like RSPs, TFSAs, and, property and stuff like that. So does your will have to be very specific for each one of the type of assets? Or could you just say, I have 3 kids, there's an executor, one of them maybe is the executor, and after they pay the debts, they share everything equally, something like that. So is that a tax question, or I don't know how detailed they have to be, these wills?
So it depends on your intentions, yes, but you can definitely put it in the pot, right? The point is that we would talk about your TFSAs and your RSPs and whatever it is, and make sure that you have proper beneficiary designations if there are any, or if it should be left to the estate as your final, you know, beneficiary, then we make sure that that's updated and whatever, and then yes, you can put everything into the pot and let it be divided equally. And we often do it like that unless you want a specific gift to be left to a particular person, because your assets will change, right? So my goal is to set it up for you right, with the intention that you don't necessarily have to change it in the near future unless some of those triggering events happen in your life, right? So, you know, and I think we're gonna put it on here.
Yeah, I'm gonna, you can
but-
talk about that
yes.
a bit, and then there's a couple other concepts I want to talk about.
Okay, yes, so yes, we don't want you to have to change it every year, every time you buy and sell a house.